Welcome to the Foundery, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
All right, welcome back, investors. Today, I have the pleasure of interviewing Arn Cenedella. He's a real estate broker and investor with over 4 decades in the industry, starting in 1978. Arn built a thriving Silicon Valley residential brokerage business in Palo Alto and Menlo Park, California, while building a sizable portfolio of single-family rental properties in the Bay Area and across the U.S. In 2014, Arn moved over to Grenville, South Carolina to start a new life adventure where he continued to invest in small residential income properties in the Carolinas. In 2020, Arn successfully transitioned his single-family rental portfolio to multifamily investments and founded Spark Investment Group to help busy professionals and parents reap the benefits of commercial real estate investment without the hassle of operating the properties. Arn currently manages and operates with a multifamily portfolio as a general partner and sponsor of over 1,100 units with a total value in excess of $138 million. So with that, I would like to welcome Arn to the show. Welcome.
Hey, George, thanks for having me. Hopefully I can live up to the billing, but yeah, looking forward to having a nice chat about real estate and hopefully provide some value to your listeners on their investing, path and journey.
Well, absolutely. I know you're going to contact for several years and I've been following your career, a lot of value I know you're going to be sharing today. But the way I like to start is to ask people, so you're at a cocktail party and somebody asks, what do you do? How do you answer the question?
The way I'd answer it is I help busy professionals invest in commercial real estate, primarily multifamily, without the hassle or obligation of the day-to-day responsibilities of operating the real estate. Passive investing, we kind of do the work and they reap the rewards.
All right, great. Yeah, creating passive investments is one of the things we're really all about over here at the Foundry. So love to hear that. But I noticed also that you mentioned that you do sponsor deals. So do you have an active business of people bringing you deals and you work with various outside groups as well?
As my career in multifamily has developed, well, let me back up. When I first entered multifamily, I started, as many people did, as a LP investor. So that's how I kind of started. I made some LP investments, made some, connections, networking within the multifamily space across the United States. I then kind of moved into capital raising, acting as a co-GP for other operators. And then after about a year or two, I decided I was better suited to be lead operator and sponsor. And we primarily now work the Greenville, South Carolina market. My primary partner, Brian Walsh, also lives here. He handles the operational side of the business, project management, asset management, property management, and I kind of hunt for deals, network with the brokers, talk to investors. So once I found Brian to handle the operational side of the business, I then kind of moved more into a sponsor role where initially I started as a co-GP.
Got it. Wonderful. Okay. So then it sounds like you're not really looking for people to send you out deals, but I do have a lot of newer investors on the call. So if you wouldn't mind, what is it like? You've really been on the other side of it, right? You started out passive, you went to co-GPs, you're working with other sponsors. What would you say if you were in that position, or for the younger investors, newer investors, what's a good way to go reach out to a sponsor or to establish that sort of a connection?
Yeah, great question. So I think podcasts are a great way of learning about people in the space. So when I transitioned to multifamily, I consumed lots of podcasts. listening to podcasts as a limited partner investor, potential limited partner investor, listening to podcasts gives you the opportunity to actually hear from the sponsor and get a sense of who he or she is. So podcasts, social media, attend conferences. There's numerous multifamily and investing conferences across the United States pretty much continually. So between podcasts, social media, and networking at larger networking events, I think those are the three best ways for potential investors to meet with sponsors and start building a relationship.
Yeah, I love it. And I think what I'm hearing your answer that it's really about active listening. I mean, you mentioned as being an LP, here's your opportunity to see all of these different sponsors. And I think that really helps maybe to have some questions in mind when you do go out and listen, because I've also heard the other opinion, which I think there is some truth to it, that if you've heard 10 podcasts, you've heard them all.
At some point, they may get a little bit repetitive, but uh, I would say one other thing limited partner investors can consider is each sponsor typically has a niche. It could be a geographic location, it could be a particular asset class, or within that particular asset class, it could be luxury downtown apartments, it could be workforce value add apartments. And so each sponsor typically has a particular specialty, a particular niche. And so, as a limited partner investor, certain deals may appeal to you more based on perhaps your risk reward tolerance or just what you think. I'm in the Southeast. I think the Southeast is a great market. I've invested in the Mountain West, and of course now a lot of people are flocking to the Midwest. So, as a limited partner investor, it's almost like you have a smorgasbord of passive investing opportunities you can choose from. And each sponsor tends to swim in a little different lake. And so find sponsors who invest in the kind of deals that make sense to you and offer the kind of risk reward ratios that you're comfortable with.
Yeah, I love it. And since we went in that direction of, exactly who you are, and I do think that that is one very valuable reason to continue to listen to podcasts. Let's talk a little bit more about, what is the R and Cenedella approach? What sort of deals are you looking for? I know from following your career, you're not about swinging for the fences. It's more about the base hits. So how do you go out there and find those good, solid deals, the ones that are going to definitely enhance your wealth, not the one that's going to end up in foreclosure or, endless, value add issues, et cetera, et cetera.
Yeah. So, yeah, great question. I've been in the business since 1978. My father is the one who taught me the business. He was born 1921, so he actually lived through the Depression, had a great real estate career, was a great investor. And so he kind of taught me a fundamental way of investing. And for me, that's one, local knowledge is important. You need to know the markets you're investing in. Number two, fixed rate debt is really the keys to the kingdom in real estate investing. Three, low leverage debt. Don't over leverage a property. And four, when you go into it, have ample cash reserves for when Murphy's Law strikes or the inevitable economic downturn occurs. And I think if you approach investing that way, you're setting yourself up for success. As you noted, it's well known within the space. There are multifamily deals that are now in trouble, and almost invariably, it's floating rate bridge debt. It's high leverage, low down payment, lack of cash reserves, and almost also invariably, it's out of area operators trying to operate property from 3,000 miles across the other side of the country. So I think if you approach it that way, you're setting yourself up for success. The other thing I would say, in my mind, real estate's always a long-term investment. And the only way I've ever seen anybody hurt in real estate is when they're forced to sell in a down market. So if you go into it properly, fixed rate debt, low leverage, ample cash reserves, local knowledge, you set yourself up for success over the long term. If there's some minor fluctuation in values, you don't care. The property's still cash flowing, it's still growing. And I can tell you, over 45 years, 46 now in the real estate industry, the overall trend on values is up. It's kind of indisputable. And I guess what I would say to investors today, does anybody think the price of housing, either for sale or for rent, is going to be lower 5 to 10 years from now than it is today? I can't find any logical arguments that would indicate that. So I think over time, the value of housing is going to appreciate. And that's the key to building your wealth, and cash flow increases as you do that.
Yeah, I'd love to amplify a couple of things in your answer, particularly for those, what I would say, newer investors, like knowing your market and the reserves. First of all, when people bring deals to me, the most common issue that I find with these deals is people don't really know the market. They can't tell me, is there a good demographic story here? Does this market have tailwinds? Or is this deal a matter of, hey, we're buying in a stable market, for example, or even a market that may have some headwinds, but we're buying at just the right price? What is really the story of this asset? And I think you really can't get at that if you don't understand the market. Not knowing the market, great way to get hurt. And cash reserves, that's one I don't hear enough about. A lot of people say, like, hey, we're okay because we got a rate cap. Well, hey, it's still floating. You still got to go renew that. Maybe more expensive as rates continue to increase, if they do, and we may be at the tip of it now. But again, it's coming back again. So whatever we say about this cycle is eventually true about the future. But those cash reserves, you will never be sorry that you had some cash reserves. Did it shave a half a point off the IRR? Maybe. But the fact that you never have to sweat, and that your investors don't have to worry as well, that's huge. And like you said, or like many people said, I'll just summarize it. In real estate, you never really lose money, but you might lose time. That's assuming that you bought right, and that you know how to manage it, and that you do have those reserves, that you financed it right too, of course. So that's very, very good advice, I think, for passive investors, active investors, really, literally everybody out there. Well, one of the things I did want to talk about today was underwriting. I know you say that it's an art and a science, and I think that's the perfect segue, because you may know, listeners, that I am a data scientist, an award-winning data scientist. Back in the day, I would go out and build predictive models. But what I really had to do was then go out and sell those models. I had to tell the story of, why does this model make sense versus another? How did it handle the past? I didn't just go out and throw a bunch of numbers up on a slide. And if I would say that I see one mistake made with underwriting, people think underwriting is just about the numbers. But I would say that underwriting is really about finding the story behind the numbers. So I'd like to hear what you think about that. Maybe you can pick up the thread from there.
Yeah, great way to express it. So tech people understand the notion of garbage in, garbage out. And so the spreadsheet, the model is great, but it's only as good as the data you enter into the model. And again, that comes back to market knowledge, and what's going on in this particular market. It's also knowing about how much it actually costs to renovate these units. In these models, you'll develop a CapEx budget. You'll predict some rent increase over time, and you have to have a feel for that, because the numbers just entered without any context don't have as much value as if the numbers entered have context based on local market knowledge and so forth. So I think sometimes people get mesmerized by all these nice numbers and columns, and they don't understand that they're based on assumptions about the future, which may or may not prove to be correct. And so I think just you have to take it with a grain of salt. I think the models are actually best served for kind of what if scenario analysis, where you change the rate of rent increase and see what that does to your returns. You change the capex expense and see what that does. So kind of going through those what if scenarios gives an investor a sense of how this deal is actually operating. So numbers are important, but they're only as good as the quality of the numbers you put in the spreadsheet.
Yeah, I love it. Garbage in, garbage out. But the other thing I loved about your answer, you talk about context. And when I underwrite a property, my goal is, I'm exaggerating a little bit, but to have as many words on the page as numbers, right? Every one of those cells in an Excel spreadsheet, you can add a comment and you can say, hey, this is how I verified that number. Or you can talk about your assumptions. Why do I believe that this is correct? What is the likelihood? You also talked about contingencies there. What is the likelihood of this scenario popping up? At least I know where your head is at. Now, if you think that, cap rates might be, 1 point above where they're at right now in 5 years, what is the probability you think they might be, 2 points higher? Getting an idea of what a person's assumptions are going into a spreadsheet like that is huge. But yeah, again, if I were going to summarize it for people out there, particularly because people bring me deals. If you want to work with George Roberts, what I want to see is the narrative. I want to see that you've really thought it through. Like Arn says, have you thought through the contingencies? So what happens when the cap rates increase and then your LTV on refinance is a little higher? Or what if interest rates go up and you don't get to do that refinance? How does this deal look like under different scenarios? How many things have to actually be true about this deal? How many things do I need to verify to know that this is a good deal? What does this deal truly depend on? Well, anyway, I hope that didn't turn into a rant. I'm really trying to be encouraging to the new people.
Yeah, and the other thing I would say is, and I think we're seeing it today with some maybe weakness in kind of the value add Class C properties. Economic factors don't affect all apartments or office or industrial retail the same way. So the assumptions you make have to be kind of specific to that property and that location. So it's a science, but you need a little bit of art in it to kind of ferret through that. So it's fascinating. And I think the other thing I would say is when we see a property we like, and George, I'm sure could speak to this, when we see a property we like, we'll do an initial underwriting on it. And that will give us some idea of where we want to offer. And then maybe we negotiate, we get it in the contract. And now we start due diligence. And as the results of the due diligence come in, we again fine tune our underwriting. So in my sense, underwriting is kind of a constantly iterative process where you continue to fine tune your numbers as more data and information comes to you. So it's an evolving process. And then the other thing, of course, people say the day you close, the pro forma goes out the window because real life strikes, which again comes back to setting the deal up properly with ample cash reserves, relatively lower leverage. That allows an operator to ride out some turbulence in the market where, and as George says, maybe it cuts the IRR a 0.5%, but at least for me and for my investors, we're happy to give up 1% on the IRR to vastly increase the security and safety of the deal. And I can say on the Spark Investment Group deals, we've paid every distribution when promised in the amount promised or more than the amount promised. And generally across our portfolio, NOI, actual NOI versus pro forma, we're generally up 18%. So you hear a lot of time conservative underwriting. I'm not sure what that really means. It's kind of a cliche now. We try to do realistic underwriting. We try to do our best ability, looking at the market realistically to kind of figure out what's going to happen in the future. So we prefer the term realistic. That's what we try to hit on, as opposed to conservative, which is so overused. I don't know that it really means anything at this point. George could probably chime in on that one too.
Yeah, good. Here, I'll go into my next rant. Yes, about all these people who have conservative underwriting. I was looking for the first person who didn't go on and on about how conservative their underwriting is. Probably the honest person in the room. So thank you.
Yeah.
We need that. Now, what I'm hearing in your answer is, I think, going back to the arts of underwriting. And you're talking about, I think you've sort of hit on some myths. Now, let me see if I could flesh out a couple of these. I think that part of being sophisticated with numbers, it's not about whether you had multivariable calculus. It's about whether you've been around the block a couple of times, that it's not your first rodeo, and that you don't let the emotions get the better of you. Because I've heard all these things from gurus like, yeah, Class C is not sensitive to the economy because people move into it from Class A and B. No, Class C, these are the first people to lose their jobs. It's sad to say, but you got to know what you're dealing with. Though that's your market, that's who you're serving. You've got to understand that when there's economic turmoil, you will have trouble in Class C, and Class C has had some issues. Here's another good one: construction. Well, that doesn't impact Class C because those new apartment rents are not what we're charging. My opinion, this is hugely wrong because it's all about supply and demand, and builders love to put supply in on the top end. Nobody thinks they're building garbage. And in general, people don't build garbage. In general, what's built is, at least for the time frame, considered nice, right? And every year, homes, even apartments, getting bigger, having more amenities, people just expecting more, right? And it's generally the case that things become Class C over time. Well, all of that pressure at the top of the market puts pressure at the rents on the top of the market, which puts pressure on Class B, which puts pressure on Class C. So I think a lot of operators have, when the market was going up, say Class C is perfect. We're going to have the highest returns, and we also have the best protection from the downside. And that just isn't the case, right? Here, I'll add one to that. So we're talking about myths here, and we're talking about experience, and we're talking about the art of underwriting. But I would say that there's also the case that you've got to be sophisticated, because if you understand risk and you understand how finance works, if Class C is the most insulated, then do you mind telling me why it has a higher cap rate than Class A? Right? That's the market telling you that it thinks it's more risky.
That's exactly right. And when you're looking at the pro formas and these returns, and you kind of hit on it earlier, you have to kind of assess what's the probability of this deal actually hitting the pro forma and the returns. And I would submit a heavy value add deal has more uncertainty, more risk from vacancy and credit loss, from the cost of renovation to a whole host of issues, versus a little bit newer property with maybe a little higher income resident demographic. And so when you're looking at these things, try to assess what's the probability of the pro forma actually being hit. And the steady Eddie deal might not look as sexy if you just look at the numbers, But I think if you dig into it, sometimes you'll see, well, this is actually an achievable business plan. This is an achievable path to success, where the other one might be kind of totally dependent on multiple factors, all of which have to go right. And if one or two of them don't, then the deal maybe has a little bit more trouble. So just kind of understand that as you're evaluating these deals, how likely is the performer going to be met?
Yeah, I love it. I also love what you said about the iterative nature of underwriting. 100%. A deal is never underwritten until the day you close it, and it's still you got to re-underwrite. For example, you got to re-underwrite your refinance, etc. The disposition. You should always be looking. What is this going to do to the IRR if we do this or that? So yeah, very. I love it. Sounds just like the chapter I'm writing right now. So just really appreciate that. Don't even know how to say how much I appreciate that answer. But it looks like we're the time for wrap. So just want to ask, make sure everybody's able to reach out to you, email, website, carrier pigeon, smoke signals. What's the best way to reach out to Arn Cenedella?
Well, George, I've enjoyed our conversation. And yes, when you have time, let's do it again. The name of my company is Spark Investment Group. Website is investwithspark.com. I'm very active on either Facebook or LinkedIn under Arn Cenedella or Spark Investment Group. Always happy to talk real estate.
All right, beautiful. And thank you so much for the value add today. You just got a ton of experience. And I love the way you expressed all the things that people need to know about the art and science of underwriting, about really how to stay safe out there. We can say that that's particularly important in today's tumultuous times. But again, I guarantee, ladies and gentlemen, it's coming back again. So listen to this interview in 10 years, and it's going to be just as relevant. So thank you for taking the time to share your knowledge and experience with our audience, Art.
Hey, thanks so much, George. It's a pleasure.